Welcome back to Factful Finance. Today, we're diving into a fundamental topic in the world of business finance: debt versus equity. How do companies actually raise the money they need to grow, expand, or innovate? Let me ask you something. What if you were starting a business tomorrow? Would you borrow money, or would you look for investors to buy into your company? It's a big decision, and it could make or break your financial strategy. The choice between debt and equity isn't just about numbers. It's about control, risk, and long-term sustainability. Let's break it down. First, let's look at debt. Debt financing is when a business borrows money from external sources, be it through loans, bonds, or credit lines. This is what we call leveraging debt. Think of it like a mortgage on your house. You borrow the money with the agreement to pay it back with interest over time. Now, what's the upside? You maintain full control of your business. No one gets a say in your operations, and once the debt is paid off, that's the end of it. However, debt comes with risks. If your business hits a rough patch, you still owe the money, and interest can stack up quickly. Think back to the 2008 financial crisis. Many companies teetered on the edge of bankruptcy because their debt payments became unmanageable. But what if you don't want that pressure? What if your business needs more flexibility, especially in its early stages? That's where equity financing comes in. Equity means selling a portion of your company in exchange for capital. In this case, you're bringing in investors, angel investors, venture capitalists, or even the public through IPOs, initial public offerings. The big benefit here? You don't have to pay back any debt. Instead, investors gain a stake in your company and share in its successes or failures. This can be an incredible growth driver, because when investors see potential, they often bring more than just money to the table. They bring expertise, connections, and sometimes an entire network of industry contacts that can catapult your business forward. However, equity financing means giving up some control. Investors want a say in the direction of your business, and they're looking for returns. This could involve relinquishing decision-making power or dealing with pressure to deliver high growth quickly. Remember, investors want a piece of the pie, and they won't hesitate to push for faster, bigger results. So how do businesses decide? It comes down to a few key factors. First, consider your cash flow. If you're generating steady revenue, debt could be the way to go. If you're more focused on growth but lack the funds, equity could provide the resources you need to scale without the immediate pressure of repayments. Next, think about your risk tolerance. Debt can be a great way to leverage your business's growth, but if things go south, you're still on the hook for the loan. On the flip side, equity doesn't carry the same risk to your personal assets, but you might have to give up some of the control you're working hard to maintain. Let's look at a real-world example. Meet Liam and Olivia, co-founders of a tech startup. Liam, the more conservative of the two, is pushing for debt financing. He's confident that their product is ready for the market and believes they can easily handle a small business loan. Olivia, on the other hand, wants to pursue equity financing. She feels that investors could bring valuable insight, connections, and long-term capital to the table, allowing them to scale faster. The two of them decide to meet with both a lender and a venture capitalist to weigh their options. After thorough discussions, they realize that debt financing offers a shorter, more controlled path to growth, but equity financing could be the game changer if they want to take risks and expand quickly. In the end, they opt for a hybrid approach, using some debt to cover immediate needs and equity financing to fund their expansion. The point here? There's no one-size-fits-all answer, and the choice depends heavily on the stage of your business, your financial goals, and your risk appetite. Before we wrap up, let's talk about the larger picture. Businesses across all sectors, whether they're tech startups or retail giants, must carefully assess their financing options. According to the latest Federal Reserve data, over 40% of small businesses rely on personal savings or loans for startup capital, which shows how critical understanding debt and equity financing is. If you're thinking about how to raise money for your business or personal ventures, ask yourself, what's your goal? What's your comfort level with risk? And what can you afford in terms of control? This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Want to learn more about building the financial foundation of your business or investing strategies? Drop a comment below with your questions. I love reading them. Don't forget to hit that like button and subscribe so you never miss out on the latest financial insights. If you found this helpful, you'll love what's coming next. Keep watching to dive even deeper into the world of financial economics.